Hi, this is David Hillier here, and I'm going to be giving a short video on capital budgeting, but I'm going to be focusing on sensitivity analysis, scenario analysis, and break-even analysis. The material that I'll be using comes from my book, Corporate Finance, but I will be departing somewhat from the actual lecture slides because I'm going to be showing in this video how you can use spreadsheets to their full power to answer some fairly complex capital budgeting issues. So, without further ado, let's start off. Now, this comes from sections 8.1 of my book, and you can read a lot more about sensitivity analysis, scenario analysis, and break-even analysis there. But we're going to start off with uh, an example. We've got a product, and that product is a solar-powered jet engine. And we have an initial investment. Now, I've got year one here. It actually should be year zero. And when you're doing sensitivity analysis, everything that you do has to, or any input into the analysis should be written in its own cell. So I'll write initial investment, and we'll put 1500 here. So the initial investment, that's the time zero investment, is 1.5 billion pounds, and the project will last for 5 years. Now the cash flows are as follows. Now what I'm going to do is I'm going to write these down. Some things to notice that this is written from the perspective of putting together an income statement, and from the income statement we then use the bottom up approach to calculate the operating cash flow. If you want to know about the different ways to calculate operating cash flow, then I have already presented a video on that, and you'll be able to get that through my YouTube channel. If we look at this though, one thing that you can see right away is that you have the same cash flow between years 1 and 5, so that means it is an annuity. In a normal capital budgeting analysis, the cash flows will change from year to year. So this is a simplification. And it's only a simplification because I'm interested in how to do sensitivity analysis or scenario analysis or break-even analysis, not the actual capital budgeting for this video. If you want to do that, again, I've got another video for that. You'll be able to find that on my channel. So let's write down uh, our income statement. So I've got years 1 to 5 here, and because it's a character or a string, it is left justified, so I need to change the alignment. We start off with revenues, and the revenues will be in years 1 to 5, and we'll write down 6,000. The variable costs are 3,000. The fixed costs are 1,791, and depreciation is 300. Now, it's the same value from years 1 to 5, so it tells us right away that we're using straight line depreciation. From this, we can get our earnings before taxes, or profit before taxes, or pre-tax profit. How do we get that? Well, it's 6,000, that's the revenues minus the sum of the costs. So we're given an earnings before tax of 909. We're now going to pay tax on that, and the tax rate is 28%. So we find the 28%. You'll see that I've got it to 2 decimal places here. The spreadsheet will be more accurate than just what I present for brevity in the actual tables. And from there we can get our net income or our net profit, which is just subtracting the tax rate from the earnings. Now, as I said, we're going to use the bottom-up approach. So for the bottom-up approach, we have to add back any accounting adjustments. In this particular case, the only accounting adjustment we have is depreciation, so we're just going to add that back into the analysis. So we have the initial investment up here. Let me just copy that down so that it's as in the slide. And so we've got initial investment and we have the income statement. So that's us put it all together. Now, in here, we could actually say, well, okay, what happens if revenues are down by 10% or revenues are up by 10%? Okay, well, yeah, we could do that. What I'm going to do is I'm going to change this around. In fact, at this point in time, let's say that that the discount rate R is equal to 15%. So we can find the net present value. The net present value is equal to the initial investment plus, now this is an annuity for 5 years, so the present value of this annuity we can get using the PV formula. It's PV, the number of periods, well, you start off with the rate, which is 15%, the number of periods is 5, and then the payment. And what we have to do in Excel, a payment is an outflow, so they actually treat the outflow as a positive. So an inflow has to be treated as a negative, and that's why I've got that negative sign there. It's just one of the issues with using Excel. And that gives us an NPV of 1700. Okay, so we're going to come back to that, but just at the moment it looks as if, yeah, this is a good project. Let's start looking at this in more detail then. What you're seeing here is something that I would cover in, say, chapter 6 when I was explaining the tools, and then in chapter 7 we go into the actual cash flows and where we get the cash flows. You'll take from chapter 7 that the majority of capital budgeting analysis is basically driven by assumptions. It's driven by your forecasts of cash flows in the future. And those forecasts of cash flows are in themselves estimates based on a number of different inputs. And what if we look at the case here, and we're going to look at revenues first, and then we're going to look at costs. But where does the revenue come from? Well, the revenue comes from the price per engine, which is 2 million, and the number of engines sold. And here the number of units sold is 3,000. So I'm going to change this 6,000 to be a formula which is based on the price multiplied by the number of units sold. Now you'll see that it's the exact same thing, but now I'm actually making the analysis much more granular in that I'm now looking at the inputs into these end game cash flows. We can even break down the number of units sold into the size of the market and the expected market share. So the market share is how much of the market do you think you're going to capture. In this case, we've got 0.3. That's the estimate. So we think we're going to take 30% of the market. And the market size is the total size of the market. And the total size of the market, that is the number of units that's sold per annum. And in this case, it's 10,000. So if we've got the number of units sold in the industry is 10,000, and you have a market share of 30%, then that would then tell you that the units sold is equal to the market share times the market size. And this allows us, if we to say then, well, okay, what happens if the market share is 0.4? You'll see that if we set the spreadsheet up, that our NPV is greater, and this 0.4 has an impact on the units sold, which then has an impact on the revenues, which then has an impact on the operating cash flow, which has an impact on the NPV. So the spreadsheet is set up properly so that any changes in your assumptions will flow through the rest of the analysis. Okay, so we've got 3 assumptions. We've got the market size, we've got the market share, and we have the price per engine. They're the 3 inputs into our calculation of revenues. Now we're now going to go on to look at the costs now. Now the costs are comprising of two components. One is the variable cost, which is linked into the number of units sold, and the other is the fixed cost, which you incur irrespective of the units sold. Now, in any analysis that I advise on, I always say that try and get those fixed costs driven down as much as possible and link variable costs into the analysis much more, because that means that you have a degree of flexibility in your analysis. If you get fixed costs, you're increasing the risk of your project. What you're doing is you're talking about increasing the operating leverage of your project, and that will be covered in a lot more detail in later on in the book and also in my videos. But let's look at um, the cost analysis then. So we said it's made up of variable costs and fixed costs. We can't do anything about the fixed costs, but we can do something about the variable costs. So the variable cost is £1 per unit. Okay, so if you look at the price, it's 2, the variable cost is 1, so it's 50% of the price. That means that our variable costs is then can be calculated directly by the total variable cost is the cost per unit multiplied by the number of units sold, which is 3,000. So again, if, for example, you can drive down the variable cost to 0.5, it has a good impact on your cash flows. So that's us set up our spreadsheet. Now we're going to go into the actual analysis itself. Now we start off with sensitivity analysis. With sensitivity analysis, you change one variable at a time and you look to see how the outcome, the net present value, changes as a result of changing one of the inputs. So if we were to, for example, say, well, okay, let's look at the market size first. We expect it to be 10,000, but it could be 5,000. So we could put 5,000 in here and we get an NPV which is negative. Notice this negative sign here, negative. And so you would reject the project if the size of the market was only 10,000. If it was 20,000, well, clearly you would accept it. It's very good because you're capturing 30% of that. And sensitivity analysis basically just goes through that whole process. It looks at pessimistic outcomes and optimistic outcomes for each variable. And it then finds the NPV for each of these variables. Now notice that for our expected case, we've got 1699.56. I've written here 1700. We can change these and we can have a number of NPVs to be negative and then positive. Now in your analysis, whenever you get a negative NPV, that's where the danger signs appear, and that is where you have to focus your analysis into saying, well, is there any way in which we can improve the chances of getting a better value for that variable? Or is this something that we need to think about hedging? Or is it something that we need to maybe put a bit more strategic thought into? So in this particular analysis, you see that the two major factors or two major risk factors is the size of the market and the market share. So for the size of the market, that can be assessed with more clarity by more market research. And the more market research, clearly it will have a cost, but you would maybe be able to get better estimates so that when you're looking at pessimistic and optimistic, you can try and get that calculated with a bit more accuracy. Market share is a bit more difficult because with market share, you can't predict how many units that you're going to sell in the future. So again, it should be market research, but there's more volatility in your estimates there, and that is something that you would then need to look at and look at other type of strategies to mitigate that risk. So the sensitivity analysis is good because it allows you to focus down on those variables that may give you or may impart greater risk into your analysis. But there are a number of criticisms in this because criticisms is that it only looks at one variable at a time. is it realistic to think that only one variable at a time will move? No, it doesn't, because each of these inputs, they will be related. So there'll be interrelationships or interactions that isn't captured by the sensitivity analysis. Another criticism of this particular methodology is that it can give you a false sense of security as well. So you know, what could happen is that you just spend all your time focusing on market size and market share in this, for this example, and forget about variable costs, fixed costs, forget about the price, because you think, well, okay, that doesn't really have a big impact on your analysis. So it may actually lead to undesirable behaviours on the part of the financial manager, and that you have to be careful about. So you can have a false sense of security with these, but it is good in that it does give you some bit of more information relating to risks of the actual project themselves. Okay, so we now move on to scenario analysis, and with scenario analysis, what we do is we actually say, well, okay, instead of just varying one input at a time, what we'll do is we'll look at scenarios. So what happens, for example, if the economy is doing better, or what happens if there's a terrorist attack, or what happens if, in this example here, that there's a crash that has an impact on like the whole market size. That gives it's a lot more detail, and it's intuitively appealing to decision makers, because um, they can think about these scenarios and say, well, how likely is that scenario to take place? So the difference between a sensitivity analysis and a scenario analysis is that sensitivity analysis, you vary one input at a time. With scenario analysis, you vary more than one input, and you create scenarios. So this is the example here, that what we've got a plane crash. So there's lower demand for engines, so the size goes down. The innovative technologies, is avoided. So we end up, we've got impact on two inputs, and those are our most sensitive inputs. So we find that the market size falls to 7,000, and your market share is actually now down to 20%. So in that particular case, in that scenario, you've got a negative NPV. So it wouldn't stop you from doing the project. What it would tell you is that, well, okay, we do need to hedge then against this. We need to put in contingencies against plane crashes. How likely is a plane crash? Well, it's very unlikely. But let's just put in a contingency in there. So that's sensitivity. Sorry, scenario analysis. You can see here that I've in this spreadsheet. That should be years 1 to 5. Sorry. In this slide, we've got the cash flows, but these have already been recreated here very quickly just by changing this input. So you didn't need to do any additional changes to the actual cash flow statement itself. Okay, and you see the formula here. We've got it already calculated. So let's go to the next part, which is break-even analysis. Now, you can have an accounting break-even analysis, and you can also have a kind of financial break-even analysis. The accounting break-even analysis basically says that, well, okay, over the 5-year project, how many, I don't know, how many units should be sold to ensure that you break even in an accounting sense. So to do that, well, I've got the NPV here. If I just do break even, oh no, let's just do net total profit. That's probably better. Net cumulative profit. And the net cumulative profit is just the initial investment minus the initial investment plus 5 times the net income. Okay, because remember, this is we're talking about a profit here. Now you'll see that under these variables, market size of 7,000 and market share of 2000, it was negative. Cumulative profit, so it was a loss. I've gone back to the original variables here, and then there's a positive cumulative profit. And the cumulative profit will always be greater than the NPV because we're discounting the future cash flows. So the NPV takes into account time value of money. Now, what we're going to do is we want to find the break-even point, and now I'm going to just expand this, and we're going to show you some techniques here. Techniques. Now, I'm using a Mac, but it's the same thing, just slightly different places. When we, slightly different places in on a PC. So what we're going to do is we're going to use GoalSeek, and I'm going to set. So what I'm wanting to do is to set the break even. So that's what we're doing, is we're wanting to find the number of units sold that leads to a break even. So we'll start off with, we want to set let's go for the accounting break even first. So we're going to set this cell equal to 0, because that's break even, by changing this for a cell, so the number of units sold. So I click OK. Cell must contain a value. So what's, by changing set cell B13 to value 0 by changing B15. Cell must contain a value. Working with Excel is the same as working with dogs and children. Sometimes you don't know what's going wrong here. So, aha! So what we got is the units sold here is based on 3,000. So what that's saying is that's a formula. So we need to then go down into the market share or the market size. So what we would then do is say, well, do goal seek again and set cell our net cumulative profit B13 to value 0 by changing cell, and the inputs into the units sold are the market share and the market size. So let's look at the market size. So what impact does this have? So the minimum market size, assuming that we get a market share of 0.3 to give us an accounting break even, is 8358. That leads to the number of units sold to be 2507. So the number of units sold, the minimum number of units sold here is 2507. We might actually say, well, let's bring this back to 10,000 and say, well, in actual fact, we're worried about the market share. So what is the minimum market share for us to have an accounting break even? So again, set cell, we're doing the accounting break even here to value 0. And this time we're going to choose the market share. And in this particular case, our market share, the minimum market share, is 25%. So we would not be able to, assuming the market size is 10,000, we would not be able to get or go forward with this if we thought that the market share was less than 25%. Now that's for an accounting break even. Accounting break even, although it's using accounting figures, you're dealing with accountants all the time, and accountants will say to you, well, it's got to make a profit. You can't enter into a project that doesn't, give you a profit. So you do need to look at accounting break even. But you might also, you will also want to say, well, okay, what's the break even number of units sold for to ensure a financial break even, that we actually increase value. So to get the financial break even, instead of focusing on the cumulative profit, you're actually looking at the NPV, and it's the same process. So what we want to do is we want to set the NPV equal to 0 by changing, let's change the market share. So by changing the market share, we have the minimum number of units sold to lead to a financial break even is 2,295. So it's the same type of process. And GoalSeek is a really good method to look at here. Now, going back to our slides now, to finish off, Accounting break-even analysis. Why would you use that when we've told you not to use accounting figures? Well, it's important just to say, well, okay, it doesn't make an accounting loss. When is financial break-even analysis important? Well, it's important in every case because it tells you the minimum number of units sold to ensure that before you increase value, to ensure that you have a positive NPV. So that's the sensitivity analysis, scenario analysis, and break-even analysis. Hopefully you've enjoyed this video. It's been a bit longer than normal, but with all the calculations, sometimes you can't avoid that. So thank you very much.